Last October, Bitcoin hit $126,000. 4 months later, it's trading in the mid-60s. That's not a dip. That's not a correction. That's an asset losing relevance in real time. Bitcoin was supposed to be the asset that played by its own rules. No central bank, no Wall Street, no correlation to the chaos of the broader market. But now, it looks like just another high-risk tech stock, traded by the same milquetoast brokers that buy and sell Procter & Gamble. Why this crash is different and how Bitcoin may not recover on this episode of An Acquired Taste. Back in December, I posted a video about Bitcoin's crash to the mid-80s. At the time, it felt like the bottom had dropped out. Then 2026 said, hold my beer. Since I released that episode, it spiraled into the low 60K range and has rebounded into the mid-60s as of this recording. But what drove the price down this time is different, and those forces point to a very different future for Bitcoin and crypto trading in general. So just a quick bit of housekeeping. I'm going to focus on Bitcoin, and I'm going to use that as a crypto bellwether. I know there are other popular coins, but let's not get wrapped around the axle parsing out the mostly imagined differentiation between cryptocurrencies and products. I don't claim to be a crypto expert, and I philosophically don't understand the value of crypto in 2026, and you're going to hear that bias throughout this episode. The price of Bitcoin will inevitably move after this episode gets published, so don't latch on to any specific number. I'm simply going to lay out the case for why this crash is different and why a depressed price is potentially long-lasting for Bitcoin. Lastly, I'm expecting a full-on crypto bro assault in the comment section. Let's keep it civil, folks. So what happened? Well, Bitcoin is currently trading in the mid-$60,000 range. The previous crash was in the November-December timeframe of 2025, where it effectively bottomed out around $85,000. Bitcoin rebounded to almost $97,000 on January 13th, but never crossed that spiritual $100,000 threshold. Not even a month later, Bitcoin hit $62,000 and change on February 4th, then had what looks like a dead cat bounce back to right around $70,000 the very next day, and has slowly retreated since then to $64,000 as of this recording. So why is this happening? Well, the brief philosophical history of Bitcoin and crypto may be helpful context here. Crypto and Bitcoin were originally thought to be a store of value, untethered to the rest of the market, currency trends, or even monetary policy. Its capped inventory of 21 million coins manufactured a supply constraint, seemingly supporting upward pricing for steady demand on decreasing supply. Bitcoin and crypto investors lauded its unregulated status and the perceived firewalls it created between normal market volatility and the price of a coin. All of this equated into what could be described as a collectible, a made-up currency that was subject to the vibes of buyers and sellers, with the hope most buyers would appreciate and lean into the ethos of this manufactured asset. And they did. Bitcoin reached its all-time high in October of 2025, just over $126,000 per coin. But trade winds were shifting. You know, one of the best ways to support small YouTube channels like mine is to subscribe. If you like the content and you'd like to see more of it, consider subscribing. Back to the episode. In January of 2024, the first spot ETF for Bitcoin was created. An ETF is an investment fund whose shares trade on a stock exchange like a stock, and it holds a basket of underlying assets such as stocks, bonds, commodities, or even crypto. These new ETFs were important because now retail investors could buy a basket of crypto, and wirehouses like Merrill Lynch, UBS, and Morgan Stanley started building their own crypto ETFs. Bitcoin and crypto were going mainstream. Layer on top of that, the Genius Act of 2025, which provides a structured, comprehensive framework for digital assets, focusing on stablecoin reserves and anti-money laundering, and this new compliance-friendly retail investor product had been supercharged. While Bitcoin is still considered a commodity, it's largely traded and, quote, regulated as a security. I won't geek out on the differences between commodities and securities. Feel free to chat GPT that later. But they are regulated differently, and that used to matter for Bitcoin. All of this started to feel like a homologation of crypto into mainstream markets. On the plus side, huge new market built in for crypto from new investors, primarily retail investors. On the negative side, Bitcoin and other major cryptocurrencies now appear to be affected by larger market dynamics. What was once a fringe boutique asset was now being included in ready-for-commission products at the biggest wealth management firms in the world. So why the crash now? Well, unlike previous crashes, there's no structural failure. There's no widespread fraud or exchange collapses. Simply put, no one screwed the pooch here. What is driving it doesn't feel very punk rock or alt asset at all. First, if you didn't know, Bitcoin is one of the most leveraged assets in the market. Investors regularly use their Bitcoin as collateral to borrow additional capital to make additional investments. This is a particularly popular strategy among margin traders. This allows investors to, essentially, profit off the increasing value of borrowed capital, and their Bitcoin is what the lender or credit issuer recognizes as collateral. When everything's going well and the value of Bitcoin remains high or even increases, the borrower is able to hold their coins and keep borrowing capital. When the price of Bitcoin goes down, obviously the value of leveraged Bitcoin goes down as well, and borrowing against the same amount of coins is impossible. If the larger market loses value, people start selling their Bitcoin to pay back the loan or interest on the loans or borrowed assets, or to meet margin calls. Margin accounts essentially let people trade on credit and usually carry a, quote, maintenance level, which means the total value of the account meets some minimum threshold or amount. When the net value of the margin account falls below that threshold, the lender issues a margin call and the borrower has to sell stocks or provide capital to cover that call. When the public markets went through a pullback in tech, software, and AI stocks over the last few weeks, margin calls were triggered, and since Bitcoin has a high degree of leverage, many Bitcoin holders sold off portions of their holdings to cover those margin calls. As those holders sold, it drove down the price of Bitcoin, a classic asymmetry of sellers versus buyers that creates downward pricing pressure. But it wasn't just the margin accounts that accelerated this crash. Those crypto ETFs I mentioned earlier had huge outflows. BlackRock's iShares Bitcoin Trust has shed over $2.1 billion in the past 5 weeks, while Fidelity's Wise Origin Bitcoin Fund, that's a mouthful, saw more than $954 million walk out the door. Crypto quant analysis J.A. Martoon said Bitcoin ETF outflows are at $8.3 billion, down from their October all-time high, marking the weakest year since the funds launched. When people sell off derivative products of the asset, like an ETF, the price of the underlying asset, in this case Bitcoin, usually goes down. Again, basic supply and demand at work. So despite the narrative that Bitcoin is somehow insulated from the larger market trends and risks, this sell-off demonstrated that's no longer the case, if it ever was. Yahoo Finance summarized the Bitcoin to market hydraulics like this. Quote, over the past year, the U.S. macro policies have promoted a broader de-risking among Wall Street allocators. This has sparked a rotation out of digital assets and into precious metals like gold and silver. For context, gold and gold-themed ETFs have seen $16 billion in inflows during the past 3 months, end quote. It's interesting they cited the rotation into gold and silver, the original stores of value. And it's not just gold and silver as an alternate store of value. It's also the broader market and its impact on Bitcoin prices. According to Rachel Lucas at BTC Market, quote, Bitcoin's drop below $64,000 was not a single event. It was the result of several macro shocks landing over time on a market carrying significant leverage built up from its October 2025 all-time high, end quote. Lucas pointed to President Trump's decision to raise global tariffs to 15% as the starting point, which rattled risk assets broadly. Quote, despite the digital gold narrative, Bitcoin continues to trade as a risk asset. When macro fear spikes, capital rotates towards traditional safe havens. Bitcoin is not there yet, end quote. In summary, the accelerants for this crash were large programmatic ETF redemptions, a highly levered derivatives complex unwinding in a cascade, and a synchronized macro tech risk sell-off that turned what could have been an orderly correction into a sharp, self-reinforcing slide. Remember this summary. I'm coming back to this in a few minutes. And I know many of you are now screaming at your screen because I haven't acknowledged Bitcoin has always been volatile. The volatility is a feature, not a bug of Bitcoin. There's reason to believe those who think this devaluation of Bitcoin is just part of a broader cycle. Part of this is quantitative, and some of this is just an attempt by crypto bros to speak a price recovery into existence. Let me start with the quant. It's estimated there's more than $200 billion in institutional investment in Bitcoin. Further, around 170 public companies effectively own around 5% of all Bitcoin. While those are not huge holdings individually, they are significant enough to create a spiritual price floor and risk mitigation of a complete collapse. This isn't a dark web, Cheeto-fingered, living in mom's basement investor meme stock anymore. Real institutions with real reputations and very real amounts of money are heavily invested in Bitcoin. Even the institutions that aren't allowed to invest directly in Bitcoin have invested in Bitcoin treasuries like MicroStrategy, effectively giving them direct exposure to that market. Gregory O'Gara summarized that because of Bitcoin's institutional basis, huge banks now collectively have billions in crypto holdings. This infrastructure and installed base makes it easier for allocators to re-add 1 to 4% positions once macro risk sentiment stabilizes, turning current outflows into a temporary cyclical reset inside a structural adoption trend. Now, let's talk through the vibes rationale for why this is a temporary setback for the Bitcoin true believers. There was a Bitcoin halving in 2024, and a halving is a scheduled event in Bitcoin where the reward that miners earn for adding a new block to the blockchain is cut in half. This happens automatically in the code roughly every 4 years and slows down how many new Bitcoins are created over time. It's Bitcoin's version of a built-in monetary policy to control inflation and enforce a hard cap of 21 million coins by steadily reducing new supply. Crypto supporters point to a belief that the hard cap of 21 million creates a supply and inventory cap, making the fixed inventory more valuable over time. They'll point to surges in Bitcoin pricing 12 to 18 months after a halving. To be honest, I didn't find any analysis around this that made an argument that wasn't just coincidental. Nothing that says that halving led to an actual price increase 12 to 18 months later, just those two things lined up on a timeline. Maybe it's out there, but I didn't find it. CME further pushes this hopes and dreams narrative, arguing that the recent crash has cleared out over-levered speculators while leaving the long-term holders and institutional base intact, a pattern that in prior cycles preceded strong recoveries. Listen, I'm all for fact-based quantitative arguments, but once you get into those arguments that sound more like nervous coin holders talking their own book because traditional market forces arguments are elusive, I'm out. So how about them bears? Well, experts believe many Bitcoin investors are currently upside down, so any bear market rally will have persistent sellers trying to get out even, which caps pricing upsize. Larry Wedro put it this way, quote, empirically, Bitcoin behaves like a high beta speculative asset, amplifying equity and liquidity cycles rather than hedging them. So in a world of tight financial conditions, it can structurally underperform for extended periods. So if investors reclassify it as just another volatile risk asset with no cash flows, it must compete for capital against equities, private credit, and AI-linked tech, where the risk-reward of those traditional stocks may look more attractive, end quote. So what's this dummy's take on all of this? Well, as I said at the top, I'm no crypto expert, and I've never really understood it. Unfortunately, I still don't. And now I don't even understand the point of Bitcoin anymore. It's not a stable asset. It's not a store of value. It's not insulated from macro market forces. It hasn't proven to be a hedge against larger market risk. It has limited utility as a currency substitution, and despite the limited supply of coins, its price doesn't seem to consistently reflect that artificially limited inventory. In sum, it doesn't do most of the things that supposedly made it unique and worthwhile in the first place. And even though it's not technically regulated as a security, it behaves like one. This isn't the punk rock alt asset it was originally promoted to be. It's gone mainstream, and as the Bitcoin investor base widened, got older, and got more conservative, those investors applied the same buying and selling behavior seen in tech stocks like Facebook and Amazon. And I'm not really sure where Bitcoin and crypto goes from here. My guess is it does rebound, but more slowly and maybe not to October 2025 levels. If I had to peg it more specifically, I think over the next year it starts to track alongside the S&P 500. It will recover, but I'm not confident this crash hasn't exposed a fundamental weakness in Bitcoin. It's possible that investors have changed the way they look at Bitcoin as an asset, and their enthusiasm for continuing to have small allocations of crypto may have dwindled permanently. Look, Bitcoin has always been a high sentiment asset because there are no underlying business fundamentals like other stocks or indexes. There's no corporate P&L, no sales reporting, no innovative product development. There's nothing. Just a coin, a price, and vibes. And now that Bitcoin acts more like a high-risk stock than a currency commodity, I can't understand the desire to be invested in this asset over tech or even consumer staples. The appeal of Bitcoin has always been the massive and irrational upside. Early investors have made millions because of this run-up. But is all the upside already baked in? I think it might be. It's hard to imagine Bitcoin doubles in value over the next 5 years. Tech stocks? There are probably a handful that might. So speaking only in terms of total returns, Bitcoin starts looking weak and, more importantly, loses the last thing making it popular, upside that massively overperforms the market. So my hot take is this bottom is not a temporary rebalancing of the market or risk in Bitcoin, but a new normal where crypto and Bitcoin will now price within a range that exists somewhere around where it is right now. I don't think it goes to zero, but I also don't think it has a rapid recovery either. And with that, I'll be proven incredibly wrong and look like a tool. But that's the price of trying to be speculative and read the tea leaves. Bitcoin has made fools of skeptics before, and it'll probably do it again, myself included. But here's what I can't shake. The thing that made Bitcoin Bitcoin, the untethered, uncorrelated alt-rock store of value narrative, that's been destroyed in 2026. Once BlackRock started selling ETFs to retirees in Florida and Morgan Stanley wealth managers are shoving it in client portfolios, it stopped being a revolution and started being just another line item on a brokerage statement. The crash itself? Recoverable. The sinking feeling Bitcoin is just another high-risk stop buoyed by the loudest voices on Reddit and CNBC? That may be more durable. Bitcoin may very well go back up, but the version of Bitcoin that inspired true believers, the one that was going to reinvent money and exist outside the system, that version already hit its all-time high, and I'm not sure it's coming back. That's it for this episode. As always, like, comment, and subscribe, and we'll see you next time.